As the U.S. markets are closed for the weekend, we are looking at the final figures from the last trading session on Thursday, November 14, 2025. Beyond Meat, ticker BYND, closed that session at $1.08 per share. That was a significant move, up 0.070 or 6.93% on the day. In after-hours trading, it crept up just a bit more, adding about a penny to hit $1.09. Now, seeing a nearly 7% pop on a stock that has been so thoroughly beaten down might cause some investors, especially those new to online investing, to think the bottom is in, that a recovery is starting. The expectation is that a pop like this must be based on good news. But the reality is, this move is likely nothing more than a desperate short-term gasp for air in a company that is fundamentally fighting for its very survival. The headlines surrounding this stock aren't about a turnaround. They're about $1 price targets from major banks, collapsing demand, and massive asset impairments that are now attracting investigations. Let's establish the common ground, because it's important to remember what Beyond Meat was supposed to be. This was the poster child of the plant-based movement. When it went public, it wasn't valued like a food company, it was valued like a tech company. It was a story stock, a narrative that captured the imagination of Wall Street and retail investors alike, many of whom piled in using their Robinhood app or SoFi Invest accounts. The expectation was that this company would fundamentally reshape global protein consumption. It was priced for perfection, as if it had the impenetrable moat of Apple stock or the growth trajectory of a young Nvidia stock. The belief was that Beyond Meat would be a core holding, a set-it-and-forget-it name you could tuck away in a Schwab Intelligent Portfolios account for decades. The reality, as we've seen, is that this is a low-margin, capital-intensive, hyper-competitive food business that is bleeding cash and losing customers. The recent trading action is where the story gets twisted. That 6.93% surge on Thursday came on staggering volume. Nearly 130 million shares changed hands. This is not the behavior of long-term investors building a position. This is not the Fidelity Wealth Management division deciding this is a generational buy. This is the definition of speculation. This is traders using platforms like interactive brokers, which are built for high-speed activity, playing a game of hot potato with a penny stock. The volatility is extreme. The stock has a 52-week low of just 50 cents and a 52-week high of $7.69. This isn't investing, it's gambling on headlines. And the recent headlines have been all about the company's desperate financial maneuvers. Beyond Meat just announced details on its new 2030 convertible notes. This is part of a complex debt exchange to deal with its 2027 notes. In simple terms, the company is pushing its debt problem further into the future because it can't pay it now. This move, while perhaps necessary for survival, is massively dilutive to existing shareholders. The company has already issued over 300 million new shares and could issue 120 million more just to satisfy these notes. That is the reality behind the recent stock pops: financial engineering, not operational success. The operational reality was laid bare in the company's third-quarter earnings report from earlier in the month, and it was an unmitigated disaster. Let's be very clear about this. Net revenues were $70 million, a 13.3% decrease from the same period last year. This wasn't a small miss. It was a continuation of a terrifying trend. And why did revenue fall? This is the critical part. Total volume of products sold dropped 10.3%. At the same time, the net revenue per pound they did sell fell 3.5%. This is the death spiral for a consumer goods company. They are selling less product and they are being forced to charge less for it. They have absolutely zero pricing power. The competition from Impossible Foods, and more importantly from giant incumbents like Tyson and Nestle, is crushing them. In this inflationary environment, consumers are not trading up to expensive plant-based meat, they are trading down and, in many cases, finding that traditional animal meat is simply cheaper. Breaking down those Q3 numbers is even grimmer. U.S. retail, the grocery store segment that was supposed to be the bedrock, saw revenue collapse by 18.4%. U.S. food service, sales to restaurants, fell off a cliff, down 27.3%. The international segments, once hailed as the next great growth story, were also down. The company is losing on all fronts. To make matters worse, the company posted a net loss of $110.7 million. That's on just $70 million in sales. Think about that. They lost more than $1 for every dollar of product they sold. This was driven by a catastrophic collapse in gross margin, down to just 10.3%, and a massive $77.4 million non-cash impairment charge. This impairment is corporate speak for admitting that their factories and equipment, the very assets they built to fuel the expected growth, are not worth what they claimed they were. And now, as of mid-November, law firms are piling on, announcing securities fraud investigations into whether the company misled investors about the value of those very assets. This is a legal and financial overhang that could plague the company for years. If the Q3 report was the body blow, the Q4 guidance was the knockout punch. Management guided for fourth quarter revenue of just $60 to $65 million. The market was expecting over $70 million. This guidance signals that the decline is not only continuing, but accelerating into the end of the year. This is what prompted analysts at Mizuho to slash their price target to just $1, keeping a firm underperform rating. TD Cowen also reiterated their sell rating. When Wall Street analysts, who are often optimistic, are united in telling you a stock is a sell and worth $1, it's a major red flag for anyone doing self-investing. This isn't a situation like Tesla stock, where bulls and bears fight over future potential. This is a near-universal agreement that the company's core business is broken. The company is burning cash at an alarming rate, $42 million in Q3 alone, while sitting on a staggering $1.31 billion debt load. This is why the stock is trading at $1.08. So, what does the company actually do? Beyond Meat was founded on the idea of creating plant-based meat from pea protein and other ingredients that would look, cook, and taste like traditional beef, pork, and chicken. They sell their burgers, sausages, and other products in grocery store meat aisles, a key part of their original strategy, and to food service partners, which once included major chains. The entire business model was predicated on scaling up production, achieving price parity with animal meat, and capturing a massive share of the global protein market. This was the narrative that captivated investors and made the stock a favorite on platforms offering Robinhood stock trading and SoFi stocks. The expectation was that Beyond Meat was the future of food, a tech company in a grocer's wrapper. The reality is that it's a struggling food company with collapsing margins, evaporating demand, a mountain of debt, and a business model that has failed to prove itself in a tough economic climate. The recent financial engineering is not a sign of strength, it's a sign of desperation. The stock is not on sale. It is priced as a high-risk gamble, and anyone looking at it needs to understand the difference between the story that was and the grim reality that is. Comment below with your thoughts. Is Beyond Meat a 2026 turnaround story, or is it headed for delisting? In summary, that 6.93% rise to $1.08 is a distraction. The expectation was that Beyond Meat was the future of food, a tech company in a grocer's wrapper. The reality is that it's a struggling food company with collapsing margins, evaporating demand, a mountain of debt, and a business model that has failed to prove itself in a tough economic climate. The recent financial engineering is not a sign of strength, it's a sign of desperation. The stock is not on sale. It is priced as a high-risk gamble, and anyone looking at it needs to understand the difference between the story that was and the grim reality that is.